All right, well, good afternoon, investors, and welcome back to Bull Sessions with Mark and Ken for our August 8th, 2023 edition. I am coming off a week of vacation, so if I'm a little bit rusty or a little bit not up to speed yet, Ken, I got to tell you, an entire week without a single second of Fox News or any media news is really kind of cool.
Did you start to shake at all, Mark? Or
Well, I did miss Maria a little bit, so I left her in the presentation today.
okay, great. All right.
And this is also the anniversary of the first night game at Wrigley Field back in 1988. So that is also a moment that just kind of date stamps for at least my family, and a lot of fun. But what we are going to look at here today, we are halfway through the Groundhog Challenge for this year. We are within 4 months of the end of the best small companies, so we're going to actually announce that we're beginning the hunt for our next set of companies come Halloween. We did pass $4 million for the Tin Cup demonstration portfolio, with emphasis on the again. And it really is kind of an interesting story. And then I want to basically just brief everybody on a couple of upcoming sessions that we're pretty excited about that we're working on. Anything else you want to add to that, Ken? Is the dog keeping you company?
Yeah, I think that's
Doge?
plenty. Yeah,
The Doge
we're
beef.
we're going to be doing some traveling ourselves, and I'll be joining you remotely from different locations throughout the nation. But at the moment, I'm sitting in my dining room, waiting for this to begin. So we're ready to go whenever you are.
Okay, we'll start with the obligatory Portillo slide. This is just again a nod in the general direction that they are not providing any sponsorship or advertising, but they should be. Um, and Ken, why don't you tell us the story of the boat down in
Yeah,
the
I'm
lower
gonna
left?
fill you in on a story about the boat right here. In my investment club, we have a veterinarian. He's been a very successful veterinarian. He and his wife do a lot of traveling, and they were recently in Florida at a friend's house. And the friend lived on one of these canals in Naples, Florida. And the friend took my friend down to the edge of the canal to the dock that was attached to his house and pointed out a pretty good sized boat. I would call it a vessel, a yacht, a pretty good sized one, almost directly across the canal from where my friend was staying. And he said, take a look at the name of that. This belongs to the guy that started Portillo's. And so since we've been talking about Portillo's off and on now, every time Mark can squeeze it into the presentation, Don sent me the picture of the boat, told me to take a real close look at the picture and I'd see the name of the boat. So I'm hoping all of you can read that name. And Mark, can you do anything to make that bigger, or am I going to have to read it for the folks? I guess I will.
You can read
I'll
it.
read it for everybody. It says Top Dog. And this gentleman that owns the yacht and that lives in the house beyond uh, uh, is somewhere in his late 80s, early 90s right now, but he's the gentleman that owned the first Portillo's hot dog stand in Chicago. So here we are with Top Dog. It's quite a vessel.
I would
Uh,
call it a small city based on
it's a
what I could
biggie.
see of it.
It's a biggie. Yeah. So here's what you can get by selling a few hot dogs. All right.
Yeah, I'm told that he received 900 million in the buyout of the company, and that's some pretty good change on some hot dogs. Unbelievable. All right, here's our standard disclaimer. No investment recommendation is intended. Everything that we do here is for education to illustrate and demonstrate the philosophies, methods, and techniques of the modern investment club movement as championed by the National Association of Investors, now known as Better Investing, or as interpreted and extended by us at Manifest Investing. So you're going to hear opinions based on those very successful procedures We're basically here to share ideas and just compare notes and just continually learn. And so please do your own homework before investing in any company. If we own something, we'll try to remember to disclose that. But again, do your own homework. We do have a monthly program called the Roundtable. It's sponsored by the Mid Michigan chapter of Better Investing. And if you'd like to be added to a reminder list, again, it's usually the last Tuesday of every month, 8:30 Eastern Time. Been doing it since 2010. Now we'll talk a little bit more about the performance of it, but please send an email to nkabula1@comcast.net if you want to be added to the reminder list. If you have any other thoughts, or particularly if after you see some of the stuff we're working on right now, if you have suggestions for future topics, please feel free to share them at either of our two email addresses at the bottom of the page. Anything else, sir?
Nope, sounded good, Mark.
All right, I'm going to kick off with a little bit different slide. Again, it's that slide that we really like to look at as we attempt to explain how we think, what we do, why we do it. And what you're looking at is a list of investments with fairly long, I would say, in the world of investing, those are extremely long time frames, most of them going back to the 1990s, either on individual companies or on baskets of companies, or those other baskets known as indices down at the bottom of the page. And again, the point to be made here is those are all annualized total returns in that middle column. That's the actual performance over the long term, and that is per year. It's annualized. This is the actual return on those investments. So anybody that's invested in Amazon since 1997, there are very, very few humans that can probably claim that, has experienced a return of 33% per year. If you actually measure the performance of the Wilshire 5000 over the same time frame, that's 8.6% per year. So you've got this 24% advantage or positive relative return to the market over that time frame.
Mark, can you give us the rationale for the choice of the dates that go with the 6 stocks at the top?
They're either dates that appeared in at manifest in one of the tracking portfolios, because these are the 5 most widely held companies or followed companies by subscribers at Manifest Investing, and throughout much of the Better Investing community. Those are very common holdings, including Fastenal down there, slightly down the page.
So that's the top 7 then, right? Those 7 stocks, the top 7 in the Manifest
Pretty much.
boards. Okay.
There might be
And
another one that sneaks in there.
the date would be fixing on a round table or on a dashboard when they first appeared on that dashboard. Is that what we're talking about?
Pretty much could be, yeah.
Okay.
Yeah, it basically is sometime when it hit the radar screen. Obviously, a company like Apple, although I'm surprised to see Apple show up in 1994, Apple really showed up in our portfolios around 2010.
Okay.
For the most part. So they're really just trying to extend that time frame. Now, the Tin Cup demonstration portfolio, which we're going to talk about next, that is actually with a start date of 12/31/94. That's what you're seeing here. And again, that's a portfolio we'll talk about next. Our best small companies, I'm just going back, Ken, to the time when we assumed the reins after Forbes basically let it go.
Okay.
So that's our years, with 8 of 9 winning years. The roundtable, that's our first roundtable date.
And folks, we could quibble on these dates for as much as anybody wanted to quibble, but I think that the point of the slide is much more general than the actual value of the return. I just think it's the groupings and how much above the indices that these stocks are. And I think we could take a uniform date for those stocks. We could take maybe a 12/31/94 date for all those stocks, or we could take a 12/31/2000 date for all those stocks, and probably still see that grouping survive without that much difference in them month to month, year to year. you've questioned me. You've sent me a lot of questions on where do I get my number for how do you measure the stock market over long periods of time? And I've always given the answer 9.5 to 10.5%. Well, it's based in these indices, which no matter where you start the measurement, you get these numbers that are somewhere generally in the 9.5 to 10.5 percentage return. When they're significantly different, like the Manifest Investing 40 widely held, for example, that just indicates that we started this particular index in 2005, and it started in a slower time than average for the markets. That's why you see the 7 rather than the 10 for their benchmark right there. But for the long-term averages, the benchmark is around 10%, and that's the number that's held for historical purposes for the last century or so,
Mhm.
right, Mark?
Yeah,
Yeah.
and the one, without giving everybody out there a headache, the other thing to keep in mind, and this is a mathematics headache for many, that 7% is actually a rate of return, and it actually mimics the actual transactions in the Manifest 40. They come and they go ever since September 2005. So we actually do matching investments in the index, and for whatever reason, the timing on those uh, just basically drops that down to a 7% number. I would expect that over the long term to approach 10%.
Yeah, it this the chart is never meant to show absolutes here. It's meant to demonstrate an idea about individual stocks, and the idea, which I think forms the basis of what we do. The idea is that you can do pretty well as an individual stock investor buying good, high quality stocks at the right price.
Yeah, and Ken is really sugarcoating it or downplaying it, because when you look at the numbers at the bottom here, again, you guys all know this. I refer to this as Indexville, and there's nothing wrong with Indexville for those who want to invest in that type of thing, perhaps through a 401k or whatever. But the numbers down there are basically 10%. Whereas you look at the individual selections made up at the top, and you can say, "Oh, Mark, you're just basically picking names that show up." Well, that's true, but these are also the most widely followed stocks. By our subscribers. You get to these type of numbers, these deliver massive differences compared to these numbers down here. Something we'll probably talk about in much greater detail again soon. But those, you could say things like, "Well, it's only 8% more." Well, only 8% more is probably worth uh, a huge chunk of money over the long term. It's more than probably it is.
Well, most of us would settle for only 3% more, Mark.
Yeah,
I mean,
3% is
yeah,
spectacular.
yeah. When you can begin to beat the market by 2 or 3%, you're doing something that is very, very rare in the investing world. If you're talking about 25, 30, 35 years, I mean, if you can just do 10%. And that's basically index investing. If you have the patience and the time for it, uh, you have a return that most people don't understand, and are significantly underperforming because they're not being patient enough, they're not being disciplined enough, and to beat that index return, even by the margins that I'm talking about, 2-3%, is a significant achievement and should be celebrated by those of you that have done it.
I'll tell you, Ken, this past week I did take a day and spent a day with an investment club in Michigan. Just utterly impressive, and their returns are, I don't know what the time frame is, but 18.8% annualized versus 14% for the market, and that is just phenomenal. What a phenomenal group, and you can see where that would place them on this chart. They're definitely up here in the stratosphere, and it's just so wonderful to watch that actually play out. So for those who say that this can't be happening, And again, as we were talking in the green room, probably going to write something up about this notion of you can't beat the market, and yet many people are fortunate enough to do so.
Well, we should give that club its due, Mark. That's one of our model clubs up in the Traverse City area. And
Mm-hmm.
we have some of those members that come to our bull session on a regular basis. In fact, one of our regular fill-ins for Roundtable is Herb Lemkool, who's a member of that model club up there. They call themselves the Port of Value Club, and they're maybe, I'm going to guess they're maybe 5 years old, and they've just done a stellar job in listening very carefully, and then being very patient, very disciplined, and following the rules that will help them stay above the benchmark.
Yeah, they asked me for an evaluation of their portfolio, and instead of responding directly to the question, I submitted an application to join the club. So, just kidding, but I would.
And by the way, they're not the only model club that we have in mid Michigan that is outperforming the indices either. I don't want to shortchange the other two model clubs that I'm aware of out of the six that we sponsor. Three of our clubs are beating the benchmark and beating it by more than a percentage point.
Yep.
And so I don't want to shortchange the other two, but Porter Value is where you were visiting, and they're one of the youngest of our clubs and doing just an outstanding job.
Yeah, and perhaps we dedicate a segment or perhaps an entire session to celebrating a few of these clubs around the country in the not too distant future. All right, so while I was playing around on Burt Lake in Michigan, the stock market went up magnificently, and then apparently you guys all lost control on Friday.
You
That
came back, didn't you?
pretty well, I was still swimming on Friday, and the
All
stock market
right.
stopped. Well, the market did drop back down to the long-term line of reasonable expectations. It was above it slightly, and you can see that the long-term return forecast is now squarely in normal territory, down towards the middle of this span. This is definitely very normal return forecasts from the companies in the value line standard edition. So that's the stock market as represented by the green lines. The return forecast, the average of all the companies in the book, is the red line. So you can see that they keep flitting around there. And in there, Ken, I did leave Maria in here for one more week, just for you.
And to be fair, the value line median appreciation has always been a little bit higher than some of the standard indexes that we look at. I'm not speaking out of turn. I think that appreciation has been up around 11%, hasn't it, Mark, on a regular basis?
It has been, yes.
Yeah.
All right, so things are pretty much back to fair value for the most part. But what I wanted to do is take a moment and just take a quick look at the Tin Cup model portfolio. That is just it's a portfolio that we have here at Manifest Investing that dates all the way back to 1994. Very simple premise. We take the maximum amount investable in a 401k, and then for much of it, basically pretend that they could have invested in stocks, and investing in stocks the same way that we do it, the same way that Walter Schloss did it. And it's basically just looking for really good companies, excellent companies at good prices. And the current holdings are on the right there. So you can see the major characteristics of those top holdings. But the thing that I wanted to just focus some attention on is the roller coaster-ishness of what you see here. And you go back to this time frame back here, which was one of the worst moments in stock market history. That dip that you see right there is one of the worst and most gut-wrenching times to be in the stock market in the history of the stock market. And it's only been 14, 15 years, and I hope I'm not the only one that's having trouble seeing, how ugly that was. The point being, you stay invested, you basically buy excellent companies at excellent prices, and you just persist. And then when you get to the right-hand side, we were basically in full blast-off mode when COVID hit here, and basically plateaued out, and then found new highs well above 4 million, and we have just now come back to 4 million on the heels of two of the best back-to-back months in the history of the Tin Cup portfolio. So you can see that the data for the month of July is right here. You can see that the Tin Cup is leading the Wilshire over the last 5 years, and then obviously leading it pretty well since inception. But for me, it's such a reminder because I can remember being at the top of this, almost as like a hump on a camel or something. Ken, I have no way to express how how stimulate. I don't know. You don't even know what to say
Well,
about that
I
bump.
think, I think, Mark, that between those two marks that you've made on the graph right there, I'm just wondering myself whether that uncharted uh, uh, time in life that none of us had ever gone through, that the stock market had never gone through in any reasonable way, that the world had never gone through this worldwide pandemic where we're running in 53 directions with our hair on fire, and everybody trying to do different things to make it not impact society, and nobody really knowing what was right, what was wrong, how to make it happen. I'm just wondering if those two marks that you've made indicate a period of time that we're never going to have to live through again in our lifetimes.
At least one of
I
those.
hope and pray that we don't have to live through one of them again. So,
Well, and even back in 2008, Warren Buffett is is famous for saying, "I want to live long enough to go through this again."
yeah.
And maybe he's thinking that we could be on the verge of another one of those. Who knows? With $150 billion in the checkbook, pretty formidable. But yeah, it I think this just goes to show, though, whatever you want to call this zone in here, it certainly was inflated or stimulated in some way. And the after effect or the withdrawal from that was pretty serious. But notice that we are comfortably above the blue line right now. I have no prediction about what tomorrow holds, other than to
I,
say that I like the blue line over the long term.
I think, Mark, perhaps it would be a very interesting topic for us to spend a couple of slides in the next 3 or 4 weeks on the very unique problems that Warren Buffett has in investing anymore. He's just a unique individual, obviously, with a huge pile of cash, but that also represents some real fundamental, pretty serious problems about investing that money so that it's actually going to have the ability to make a decent return. It's not as easy as you might think to put $150 billion to work.
Well, I'm crying a river and my heart's breaking, and he still owes me at least $1 or $2 a share for Clayton Homes. So I have no sympathy for the man. I mean,
Well, I'm not saying we do it. We do it to generate sympathy, but I think we need to do it to make it clear that small investors can get away with a heck of a lot more than Warren Buffett can get away with. And
it's
I don't mean get away in any kind of an illegal way, in any kind of a break the rules way. I just mean in investing money, small investors can sneak in and sneak out, and without really bothering the market too much. Warren gets involved, and he's the market mover in whatever it happens to be then.
Yeah, I'm with you 100%. Like I said, well, we're going to take a look at that. Yes, you can beat the market article that is centered on Buffett and his exploits, and we will be taking a closer look at that. More on that to follow. All right, the holdings are on the right-hand side. We'll be adding. I'm going to pass on the top three or four and probably accumulate in mode. One of Ken's favorites here. We're going to talk about Generac and what happened to them here over the last few days while I was swimming. And
Yeah, I don't own many of these Tim Cup stocks, Mark, but going down your list, that's the first one I actually own.
yeah,
So
the numbers are good, and it's got
we're
it's only 4% of the stake, so
we're getting a nice comment from Ann Manning down in Houston, Mark, who suggests that you might want to spend a couple slides one of these bull sessions in explaining just how it is that you pull these slides for the round table, or I'm sorry, for the tin cup, and then focusing on Regeneron, why it's still in the tin cup. You know, that those might be good bounces or good trampolines to start a discussion about where do you come up with the ideas, how do you get them into the portfolio, and when do they come out, if ever, you know.
Good thought. Now, in the case, since Ann brought it up, we do have an average, weighted average return forecast of only 13.2%. We would really like for that to be 14 to 15 for sure. And the way you get that is by considering the sale of something like Regeneron and accumulating the ones up at the top. So it's a worthy thing to talk about. It also dovetails quite nicely with where we'll go with Hugh McManus in a couple of weeks talking about Regeneron.
And also reducing your cash ups that par too. Everybody should keep that in
Mm-hmm.
mind. Cash is in that their calculation only 4.5% return, better than 1% like it used to be returning, but
Mm-hmm.
still 4.5% is not the 15 or 16 that we'd like to see in a portfolio like this.
And America's Car Mart's probably on a very short leash. It's got a fairly low quality rating, so um, we'll just leave it at that. That company is probably on a very short leash. Last subject to mention before I move on: Service First is part of the banking tumult or turmoil this morning. Fitch has released all their downgrades and watch list regional banks this morning. Service First was not on the list. Neither was Western Alliance in terms of the negative listings, but a number of fairly significant banks were, including the bank out of Minneapolis. I've uncommitted it from memory, but Northern Trust was on the list and a couple others. All right.
So the only other one, Mark, that we might want to take a look at too is I've noticed in my own portfolios that MDC Holdings has had a tumultuous quality line. It's not been as consistent as I'd like to see a quality line, and that might be another one with a relatively low par value attached to it. That might be another one that we might want to take a little bit of a look to. It's one of your smaller holdings at the moment too.
Yeah, and keep in mind that we do this very almost robotic, almost mechanical, with a little bit of judgment thrown in from time to time. I have to tell you, though, I grit my teeth every time I see MDC, and I wish it were green brick or something like that instead. So
Yeah, well, I'm looking at not so much the percent of total column. I know the quality line's been not the kind of quality line I'd like to see,
mm-hmm.
but I focus on that growth for that particular company,
Yep.
and we just don't need growth like that if we're going to try to pull this portfolio up to 15, 16.
Yeah, we'd
That
love.
growth has to be near 12 and a half to make that work. Yeah.
Yep. And those are all considerations, and that they would fit very nicely with what Ann has suggested.
Yep.
All right.
Yep.
So here's a quick look at what's gone on at Generac. It's been a company of fairly high interest level. It was vetoed by Ken for our grid portfolio, and as it turns out, he's right again. Going from 160 to 110 in a couple of days is unpleasant. That's the graph on the upper left. You can see the longer term perspective. Um, if you believe that this type of stuff is going to continue and not be threatened by the pickup trucks with their own generators and batteries, probably something to think about. But wow, that's quite a haircut for it. It was the top performer not in the portfolio. Now if it were in the portfolio, it would be the worst electrification stock that we would hold. And you can just see some of the reasoning there offered by the Motley Fool. And basically, it comes down to them guiding lower on their future expectations. So that's what happened while I was on vacation. during my summer vacation. Here is a quick look at the profile of the company. And what you see happening is basically a moderation, straight out of the CEO's mouth about, expectations for future growth. And when that happens, you have a deflection in this trend line. It's basically deflecting downward from what it was. You go back a couple years, we're talking upper high teens for this company when it comes to growth rate. We're now looking at 14. That's the primary reason that the return forecast has dropped while the stock price has dropped. So a weakening of fundamentals a little bit. I would also argue, much like Ken has a few times, that this PE ratio might be just a tad high, inflating this number a little bit because the projected return on value is 16. We would like to see those line up a little bit. So again, the story here is the company basically putting out the diminished expectations for 2023 and beyond, and that is dragging down the longer term expectations. Even though they had fairly decent operating results, at least above expectations, the company did lose 24%. I believe that's in one day. Anything you want to add to that, Ken, or you want to keep sticking voodoo needles in this company, or?
I'm perfectly happy just to listen to what you're saying, Mark. Okay.
All right. Here's the Groundhog at the half. What we have here for you is the top 50 instead of the top 40, the top 50, because these are the 50 entrants that are beating the Wilshire 5000. So about a third of the participants beating the Wilshire 5000. So we're kind of back in a little bit more customary turf for the people in the contest. It's really nice to see 7 digits in the balances on this account. And as Ken was saying, the value line arithmetic average is really down far below where it normally is at 98th. Actually at a negative value right now since Groundhog Day. Kathy Wood has dropped back down to 91st. The monkey is still near the bottom. And just some real nice names on here. The leader is, of course, that screening criterion that we have dubbed the launch pad. And it's composed of companies, we'll look at them in a second, that are basically poised to go from breakthrough earnings, breaking through into green or black ink, and continuing forward. That's the concept of the launch pad. We'll probably spend a lot more time on that as we go through our hunt for the best small companies for the next 3 months. But a lot of very familiar names on here. I see, Ken, you've snuck up to 14th.
Yeah, I'm very pleased with that. I told you before we started, I'm going to have to take a look at the portfolio because I don't know what's moving it so dramatically up so many places. I was down around 30, 35, 40, so I don't know what particular stock has taken off, but I should find it and thank it when I take a look at the portfolio. I'm also very pleased that my own investment club, my personal investment club, the Wolves, has moved into the top 50. We were down around 90 something, so it gives a little bit of validity to the fact that we did choose some good, strong stocks that over the long run, none of these stocks in the portfolios that I've put into the Groundhog are what I would call speculative. They all are basically our own top of the portfolio stocks. The method we use to enter the Groundhog competition is to put our portfolios onto a manifest dashboard and then choose the top 5, 6, 7, or 8 to go to Mark to sit for the next year and see how they do. So they're all stocks. Since our lists contain our owned stocks and our like to own stocks, sometimes they're not all entries. They're not all positions that we actually hold for real, but the majority are positions that we actually hold. And this is a rough indicator of how the top of our portfolio at least is doing. Now, there's bias because we're choosing only the top 5 or 6 or 7 or 8, not, from a list of maybe 15 to 25, but it makes it easy to enter the contest, but it also gives us a good rough idea of how the portfolio is performing itself.
And I think a lot of the participants, I know that our three-time champions at number 41, the Bauer City Ladies, they everything in their Groundhog portfolio are the most highly ranked stocks that they actually own. So it's always been that way.
It's
So
variation on a theme that's doing it the same way. Yeah.
Mhm. All right.
Yeah, and there's those 2 stocks from that area where that club that you just visited, Mark Povic,
Mm-hmm.
up in Traverse City, Cool Kids and Cherry Capital, 34 and 37, are both from that same area up there. So
Yeah,
there's some pretty decent stock pickers in that particular place.
we have speculated that there's something in the water near Traverse City, but Ken, after spending some time up there, I think it might be the vineyards.
All right.
Is definitely providing the right boost. Here's a quick look at the leaders. This is, again, it's a screening criteria, so it's a celebrity groundhog. They're not eligible to win the individual groundhog gold, but this was a group of companies that were positioned for an incremental or substantial jump in earnings for 23 versus 22. Upstart, all I know about that company is they are kind of a matchmaker between people needing money and people who loan money. That's about what I know for that one. And they've gone from an original value of 200,000. There's 5 entries in this portfolio to 436,000. So just cranking along big time. But these are the companies that compose that leading celebrity groundhog portfolio.
I doubt if we'd find any of these companies in very many of the other portfolios that are in the contest. They certainly are unique names. Not knowing what 4 out of 5 of them do makes me
Well,
makes me a little
Intel,
bit worried about the whole thing. Yeah,
I'm surprised to see Intel here because Intel was really getting bashed a year
yeah.
ago, and look at them there. And then one exception to what Ken just said, Fidelity National Info Services is held by a number of clubs. I don't know if they made the Better Investing Top 200, but you can see with the quality rating and where they're at here. And of course, Trip.com is fairly well known, and they're recovering. All right, here's the companies we chose last Halloween, and we again will be fairly carefully searching for the new candidates for Halloween this year. And so if you find an exciting small company, please bring it to our attention as we build out that list between now and then. We're basically where we were at a couple weeks ago, but we have gained on the Wilshire 5000 that we use for the total market index here. And Portillo's seems to have stumbled a little bit. So Top Dog is letting us down, at least over the last couple of weeks. But in general, nothing here to be too greatly concerned about. We're not going to do any active trading like we did last year. At least I don't think we will, Ken. And I continue to have hope for a couple of those down at the bottom.
We're getting a suggestion from I think it's Marie here. Let
Uh-oh.
me make sure that I'm telling you the right person. No, it's Kay. All right,
Okay,
and
like
I'm not sure that I'm going to give you good information here, and I'm going to ask our audience if they know the answer. Kay wonders if Portillo's wouldn't be doing better if we pronounced it Portillos. All right, and I know that if this were a Spanish word, the ILL would be a Y. It would be Portillos if this were Spanish, but this is Italian. So if there's anybody out there that speaks Italian, is the ILLO pronounced illo or io in Italian? I'm not sure. So give us an answer here, audience. We know how good you are at it a lot of times. So,
And
but go on, Mark. Yeah,
as shareholders, I don't care how you pronounce it as long as you can order at the register.
as long as you can eat the hot dog, huh? Okay.
So I don't see anything else to dig into. Yeti had fairly decent results. The one thing that I will note, and this actually includes Generac, Ken, um, up around Burt Lake is surrounded by a fair number of relatively affluent homes, which they refer to lovingly as cabins. Um,
Relatively affluent, yeah.
yeah, and there's just a whole lot of renovation and construction and tear it down and build a new one. Um, I think that speaks volumes in some type of anecdotal way for, Malibu boats. There's all kinds of Fox Factory stuff up there, Ken. Obviously, anything involved in the renovation of properties. Um, I don't know. I think if that is any indication, the luxury stuff and stuff like Malibu boats and whatever. I don't know. It was just interesting to see that level of economic positivity up there. So just an observation from the trenches. All right. Well, here's a contribution from Sean Mason and his friends at Reddit. I do find this person. I asked Sean if he was Warren Omaha. He claims he is not. Um, but this individual does seem to put out stuff fairly consistent with our look at the market. This particular list would come very close to a Hugh McManus search for companies that are trading at a discount or very close to their 52-week low. And notice that Generac does make this list along with several other companies, including Enphase, which is part of our electric portfolio, and a number of others that have been mentioned recently. Any personal favorites here, Ken?
Well, I actually own EPAM and I actually own Dollar General.
Okay.
Dollar General in a club account, EPAM in a personal account. So it's it's an interesting list. We've had Estee Lauder on a couple of Pounce lists, and after a while, we've removed Estee Lauder from a couple of Pounce lists. So it's not something that we think going forward is going to do what we thought it was going to do. We've had the same feelings looking at NASDAQ, and that's not the NASDAQ index. That's the actual company that owns the NASDAQ stock exchange.
Right.
And we've taken a look at it and concluded that it actually wasn't going to give us the kind of growth that we would like to have, that we were going to need to make things work. So
Right.
those two we've given consideration to. We're pretty. The two clubs that own EPAM are still pretty solidly behind EPAM, and the one club that owns Dollar General is very solidly behind the idea of Dollar General. My wife, however, that used to be a huge proponent of these dollar stores, is saying that the experience of shopping in some of these stores has gotten to the place where she just feels a little bit grungy walking around the store itself, that it's not the kind of fun experience that it used to be. They're not staffed correctly, they're not cleaned correctly, the stuff is all jumbled up and not the merchandise isn't displayed very nicely, and she's lost her uh, enthusiasm for investing in the dollar stores. And she and I both got out of the Dollar General position that we owned. So I don't know. She's pretty accurate when it comes to picking stocks. So I'm
Yeah.
gonna stick with her feelings about it. but we still do own it in one of the clubs that I belong to.
Yeah, I do think, again, they're becoming almost ubiquitous uh, around much of the Midwest, especially in the smaller towns. And then the company has openly shared that they have many of the issues. In fact, they got sloppy with pricing and got dinged pretty good for that. So
Well,
management
there,
is,
there's another issue with Dollar General too. I'm going to shock the audience. We still get a newspaper, and our
oh,
newspaper
dinosaur alert.
is, I know,
Dinosaur alert.
dinosaur. And there's a conglomerate that puts out our newspaper. It's made up of 5 or 6 small Michigan cities, and they work together to do a lot of the feature work. And recently, they had a 3-page. I mean, newspaper sheets are big pages. They had a 3-page expose on keeping Dollar General out of your little town, and they were showing the fights that some of the counties in Michigan were putting up against
Wow.
Dollar General to keep it out. Eaton County, which is up near Traverse City, which is the Leelanau Peninsula, and the town of Leland, and some of the small towns up there, have actively fought the corporation to keep it out of their confines. They don't want this kind of store, and that's becoming a real problem for Dollar General that depends on growth of upwards of 350, 400 stores a year.
Hmm.
That ubiquitous word has become the point that it's almost like Starbucks, that you can't go more than 3 corners without finding a Dollar General anymore. So there's a couple of other issues facing Dollar General besides the pricing issues and the quality of the interior of the stores. It's the fact that municipalities don't want them,
Hmm.
especially municipalities in areas that consider themselves, dare I say, a little bit better than everybody else. All right.
All right, I'm going to try to avoid that one because I can remember a debate on the Securities Review Committee for Better Investing years ago about Dollar Tree stores, but that's a story for another day. Anyhow,
All
here's these
right.
companies laid out in the way that we look at the world. The way we look at the world actually explains some of what Ken mentioned about just not quite enough from Estee Lauder, for example, in these returns. Um, you can also see that some of the more interesting returns from companies like Catalent, Enphase, Shutterstock, perhaps, and then of course the quality ratings. But um, if you look at the relative strength index for current opportunities, this one kind of jumps off the page a little bit. Again, that's part of our electric stocks. They make a lot of the components that go into power lines and stuff. This is the proximity to the 52-week low. The negative there just simply means that the low for the year hasn't reset in the database. Estee Lauder is at a new 52-week low. And then on top of that, really decent return expectations from that group. Notice that Morningstar and the analyst consensus are pretty consistent across the board. There are some really low numbers here, to the point of some of those being probably too good to be true. Even this one, got to wonder. The analysts are very enthusiastic about the expectations for Enphase Energy. That kind of
What's this
scares me.
Catalent do, Mark? Do you know?
Catalent, boy, I'm thinking medical technology of some kind.
Okay, just another one that the analysts are very enthusiastic about. Yeah.
Hmm. So you can see the tremendous enthusiasm for some of those companies looking at that analyst consensus column. I mean, look at this right here. The expectations for Shutterstock to be almost doubled over the next year. Interesting, interesting, and of course, the Shutter product is also quite ubiquitous. So
Mark, what do you make of it when the price to fair value is at 45%, but the total return number is under 10, the
uh,
1 year total return number for Catalent?
could be a relatively low number of analysts following the company. Obviously, there's a bit of
Okay.
a divergence. That's an average return expectation, and a way uh, below average price to fair value. So
Yeah.
uh, just probably a small sample size and divergent opinions.
Okay.
And I do think that this Star Surgical is probably worth taking a closer look at and at least watching. All right. So with that, here's some of the stuff that we are going to be looking at over the next few weeks. Most likely next week, Kevin Gologly will join us to take a closer look at this evaluation of common stocks by Arnold Bernard. He's the originator, the inventor, the creator of Value Line. And that entire discussion is going to be focused on things like quality, this notion of picking a set of stocks for the year 2048, 25 years out. So that's kind of what the discussion will center on. I may sneak in some of that Berkshire Hathaway stuff into that. Don't know yet. On the 22nd, Hugh McManus is going to try to join us for a look back at one of the most popular programs we've ever done, the FDA approval pipeline. And the one from about 10 years ago featured the obesity drug race between Arena and Vivus, and there was actually a third in there. But again, he was going to basically share a look at that with an emphasis on Regeneron. And the company that Regeneron is today, this goes to Ann Manning's question about Tin Cup. Hugh will probably, and I don't want to put words in his mouth, he's probably going to paint the picture of Regeneron having more potential than the analysts probably comprehend at this point. So that will be in there. I don't know, Ken, we might sneak some stuff in there on Lilly and Novo also.
Novo Nordisk, yeah.
So we'll see how that goes. I would like to hear Hugh's thoughts on all of those subjects. So we'll look forward to that.
I'd like to hear Hugh talk to us a little tiny bit also, Mark, about whether he knows of other companies that have entered the approval process for these type of drugs that Lilly and Novo Nordisk are getting all the press about right now. If what I heard on television today was even halfway true, then there are 3 or 4 other companies that are making significant progress in that area as well, which I don't know. I don't know what they are.
Yeah, and I think part of his, I actually have some slides from him. Part of his slides go into how you can cross-reference areas of exploration. So this would be obviously the obesity drug, and you can actually do some cross-checking and expose. It's a lot like Crunchbase. I don't remember the exact name. He will cover that as to how you can see who else is in the field and what they're trying to do. And then last but not least, within the next month, we will spend a session or a good part of a session with the Thrift Savings Plan, basically bringing those funds to life on the Manifest site, replacing them. And this was one of our most popular programs about 10 years ago. And it's overdue bringing it back and giving it the resource and dedication that it needs. There's a lot of people out there, including some of the people who work directly with Manifest, that can benefit from us spending some time there and basically going back and doing that humility moment of how did we do 10 years ago versus what actually happened, and just put some of our own philosophies and techniques to work there. Here's a reminder that we do archive all of these sessions, the bull sessions, the roundtables, and any special educational topics on the Manifest Investing YouTube page. If you subscribe to the page, we have over 1,000 subscribers now. If you subscribe, we'll let you know anytime that new content is added. All right. So our closing photography, I didn't share one from my vacation because I just thought this one was pretty magnificent. I don't know if this is the view from anywhere near David's house, but you can see that that is a pretty spectacular shot. He's a retired medical professional who is a professional photographer, and that's a pretty good capture, I think. He lives in the Grand Junction, Colorado area, so he's got plenty of vistas out there to practice on.
That's the far side of the Rockies. Yeah. The western slope of the Rockies.
So good stuff. Anything else on your mind, Ken? Or
No,
the audience?
Len is just telling us that Catalent is uh, a fairly interesting company dealing with solutions for different things. And it might be a company for us to take a look at, Mark.
When he says solutions, does he mean in medical
We're
research?
talking about yes, in medical research.
Okay.
Let me go back and grab that phrase again. Develops and manufactures solutions for drugs, protein-based biologics, cell and gene therapies, and consumer health products worldwide.
That could be very interesting. And it shows up
Yeah.
fairly high on the list. It's got a 12% growth rate, so maybe that's on the small company pile for consideration. Very good. All right. So with that, I think we'll go ahead and sign off. And stick around for questions if there are any, Ken, but we'll go ahead and shut down the recording. Thanks, everybody. Good luck out there. And please do better than you did for me as an investor on Friday. Thanks, everybody.